Hi, I'm Jimmy. In this video, we're looking at the Archer Daniels Midland Company, ticker symbol ADM. This video is part of our Dividend Aristocrat series, where we're analyzing each of the companies in the Dividend Aristocrats ETF. The goal of this series is to see if we can find the top dividend paying stocks or the top dividend aristocrats that have a good chance of paying us reliable dividends in the next couple of years, and ideally get us closer to our personal goal of financial freedom. Okay, so first we're going to dive into Archer Daniels' business, and then we'll see if we can come up with a fair value for their stock. Okay, so broadly speaking, they have four main categories. They have oilseeds, carbohydrate solutions, origination, and nutrition. And then they have other, but that's kind of small, so we're just going to skip that. Okay, so this might give us a basic idea of what Archer Daniels does, but let's try to define it a bit more clearly. So they're one of the largest processors of agricultural commodities. They take things like corn, oilseeds, and wheat and convert it into products for food, animal feed, or even industrial energy products. Okay, so to make this even simpler, basically what Archer Daniels Midland does is they buy crops from farmers, they then ship those crops, store them, and process them. And finally, they resell them to food manufacturers or companies that make animal feed, or perhaps ethanol companies that use corn or other commodities. Now we have an idea what they do. Now let's look at some of their numbers. This is their revenue chart going back to 2013. And as we can see, they've had their revenue drifting lower for the last few years. And we know that a lot of their business revolves around them buying and reselling things like soybean or corn. And many of us may realize that those are publicly traded markets. So I was curious how those two commodities have done over this very same time period. And I'm sure it's not a surprise to anybody after seeing the revenue numbers, but this is what the soybean futures look like going back to 2013. And as we can see, they actually look fairly similar to what their revenues numbers look like. And if we overlay revenue, well, we can see that broadly speaking, the two seem to move about in line with each other. Sure, it's not exactly the same, but there does seem to be a positive correlation between the two of them. Now, soybeans aren't the only commodity that they play in. They also work in corn. In the corn market, they're a fairly big player. That's what the corn chart looks like. And we can see that corn prices over the same time period doesn't look all that different than the way soybean prices looked. And if we think about it, this actually makes a lot of sense. A higher corn price or a higher soybean price would mean that it would cost Archer Daniels more money to buy those products from the farmers. So they buy them for a higher price, but then they resell them for a higher price, hence higher revenue numbers. Now, if this thought process is correct, well, that would mean that profit margins would have to be somewhat consistent over the same time period. And when we switch over to net income profit margins, which is the same as just profit, well, we can see that broadly speaking, it has been fairly consistent over the past few years. As we can see, they've been putting up somewhere between 1.5% and 3% profit margins each year. And our first thought might be, this doesn't seem like a very high profit margin, and that's very true. This is actually quite low, but it's not that surprising in this type of commodity business where you're very often competing mostly on your price. So, not very big profit margins, but fairly consistent profits. By consistent, I mean, I went back in their financial statements going back to the 1980s, and in all that time, I was not able to find any down years. By any down years, I mean, they didn't lose money in any one year. That's including the Great Recession. So clearly, there's a certain amount of stability with this type of business. And that's likely to be a very good thing for investors interested in the consistency of the dividend for this type of company. Now, it's also not to say that this company is perfect. Archer Daniels Midland, just to illustrate, they have fairly suspect free cash flow. And as we could see, free cash flow has been negative for the past few years. And if any of us have done any research into Archer Daniels Midland, well, we may have noticed their negative free cash flow. But this is actually trickier than it looks at first glance. I know oftentimes this is quoted as a negative, and it is. There's no doubt about that, but it's not as clean cut as it might appear. Let's look a bit closer to see what's happening, and then we'll see if we can value ADM stock. Okay, so this is a screenshot from part of Archer Daniels' cash flow statement from the end of 2018. And as we can see right here, that their operating cash flow is negative. And we might know that operating cash flow is one of the numbers that you could start with to calculate free cash flow. But what's interesting about this is look at their 2017 operating cash flow number. Let's call that about a negative $6 billion number. But what happens when we switch to the very same section, but this time, instead of 2018, we'll look at the 2017 annual report? Well, suddenly, the 2017 number is a positive $2.2 billion. Well, we might ask, what happened? Well, what happened is, in 2018, the Archer Daniels Midland Company adopted a rule, a US GAAP rule, that required them to account for this deferred consideration in securitized receivables. And broadly speaking, this accounts for the fact that ADM sells their accounts receivable to a wholly owned subsidiary. And this would typically move cash flow around in the cash flow from investing section. This moves part of it back to cash flow from operations. There's also a piece in cash flow from investing. Now, I'm not 100% sure that this paints the most accurate picture for us, but if we switch back to our discounted cash flow, to our free cash flow chart, well, we can see here that the reason that there are 3 negative years is because Archer Daniels Midland had to account for that change retroactively. So they had to include it in the past couple of years. That's why you end up with 3 negative years. So this isn't quite as clean as it's sometimes presented to be. So I'm not sure with all this craziness, it makes sense to use discounted cash flow. So here I think it makes more sense to use a simple PE multiple. So this is Archer Daniels' historical PE multiple going back to 2015, so the past 5 years. And the average of this entire time period was about 16x. So if we take their adjusted earnings per share over the past year, over the past 12 months, it'd be about $2.93. We multiply that by the 5-year average of 16x, and we get a fair value of about $47 per share for Archer Daniels Midland stock. This would imply that their stock should be trading at about 47. It's trading right now at about $45 per share. So it seems that, broadly speaking, Archer Daniels is about fairly valued right now. Now, if we're analyzing this stock because of the dividend history, and ideally we want some more choices, because I'm not sure it makes sense to buy this stock, I want to buy it at a bigger discount. Despite the fact that they have a very stable business, I'd want to buy it at a discount to our calculation of fair value. That being said, it might make sense to focus more on ETFs for dividends. And if you're interested, well, I actually did a video on ETFs that pay a monthly dividend. I recently did that video. It's right here. There's a link here. There's a link in the description below. So if you're curious, that could be a good next video to watch. And I want to thank you for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.